Welcome back to the deep dive. You know, we like to go deep on a topic. So today we're diving into Trade Like a Stock Market Wizard, the book by Mark Minervini.
Oh, excellent choice.
You've given us some great material on investing. So are you ready to really level up your stock market game?
It seems like it.
I think so too.
Let's unlock some serious wisdom.
Well, it's interesting how right out of the gate, Minervini tackles this idea that, most people struggle in the stock market.
Yeah.
He really kind of confronts that reality.
He does, but the refreshing thing is that he doesn't leave you there.
Right.
He says, you know what? Anyone, regardless of background, can achieve super performance with the right approach.
Okay, so I love that. Super performance. He's not just talking about, beating the market.
Yeah.
He's talking about crushing it. But isn't there some element of, luck involved? How does he kind of reconcile that with his emphasis on skill and strategy?
He tackles that head on. He says, look, consistent success, it's not luck. It's knowledge, it's skill, it's discipline, much like a surgeon honing their craft. And he even uses his own story, dropping out of school in 8th grade and building a fortune, to demonstrate that it's not about pedigree, it's about dedication.
Wow, that's quite a story. So he's really debunking that myth of the Wall Street insider having all the advantages. But what about this idea that you need a ton of cash to get started?
He bucks that one too. He actually encourages people to start small, with real money, even a small amount, to gain practical experience. It's about, learning the ropes in the real arena.
Makes sense. Kind of like you can't just, read a manual to learn how to swim. You got to jump in the pool.
Right, exactly.
Okay, so this is where I think it gets really interesting. He actually argues that individual investors have an edge over these big institutions. But hold on, don't institutions have massive research teams, resources? How can we possibly compete with that?
Well, Minervini points out that institutions often get stuck with large cap stocks. Their size makes it really hard to maneuver in and out of smaller, more volatile investments. So he likens it to a giant cargo ship trying to navigate these narrow, winding waterways.
Well, we are like nimble speedboats, able to kind of zip in and out of opportunities that these big ships just miss.
Exactly.
So we can seize those high-growth plays, especially in the small-cap arena, before they become institutional darlings.
Precisely. That's the advantage we have, the ability to be quick, decisive, exploiting these niche opportunities that might not even register on the radar of the big players.
Okay, so let's shift gears a little bit and talk about Minervini's kind of core strategies here. He talks about these 4 stages of a stock's life cycle.
Yeah.
He seems particularly interested in stage 2, the growth phase, as the sweet spot for investors.
Right. He calls stage 1 the neglect phase. This is where a company might be, undervalued or overloaded. And the trick is identifying those that are transitioning into stage 2, that explosive growth period. Think of it as spotting a rocket just before liftoff.
Oh, I like that analogy. So how do we actually spot those stocks, poised for takeoff? How do we find those hidden gems?
Well, he provides a toolkit of characteristics to look for in each stage. It's about, analyzing trends, understanding the company's story, looking for signs of accelerating growth.
And he's really big on earnings, isn't he?
He is.
Not just earnings growth, but accelerating earnings growth.
Absolutely. And he digs deep into what drives those earnings. He cautions against companies that are just juicing profits solely through cost cutting, which it might look good on paper, but it's not sustainable.
It's like a sugar rush. It's a temporary boost, but it doesn't address this fundamental need for top-line growth.
Right.
So he wants to see those earnings driven by genuine demand, not financial engineering.
He actually compares it to a cockroach effect.
Oh, okay.
If you see one, chances are there are many more lurking out of sight. So cost-cutting might be a symptom of deeper issues.
That's a pretty vivid image.
It is.
So he's looking for companies with strong revenue growth, expanding profit margins, earnings that are consistently exceeding expectations. But what about valuation? Doesn't he say that even stocks with eatingly high PE ratios can still be great investments?
He does, and this is where it gets really nuanced. He explains that the market is forward-looking, meaning it prices in future earnings potential. So a company with a high PE ratio might seem expensive based on today's earnings. But if those earnings are projected to explode higher in the coming years, the market is essentially betting on that future growth.
So it's about understanding, the story behind the numbers.
Exactly.
If a company has a compelling narrative, a disruptive product or service, a track record of exceeding expectations, the market might be willing to pay a premium for its stock, even if the current PE ratio seems, lofty.
Exactly. And he uses examples like Yahoo, which at one point was trading at a PE of over 900.
Wow.
The market wasn't just looking at the current earnings. They were betting on the company's potential to dominate the emerging internet landscape.
That's incredible. I mean, it really highlights how understanding a company's story and its potential for future growth can be just as important as analyzing its current financial metrics. But doesn't Minervini also talk about the importance of price action and charts?
He does. He compares charts to an EKG for a stock. It gives us this visual representation of the battle between supply and demand. He argues that by studying charts, we can glean insights into the behavior of institutional investors, identify patterns that suggest accumulation or distribution.
So it's like we're reading the footprints in the sand, trying to figure out, who's coming, who's going, where are the big players placing their bets.
Right.
But chart analysis is often seen as a bit, subjective, right? So how does he make it more objective, actionable?
Well, Minervini emphasizes specific patterns that signal a stock is ready to move, like the volatility contraction pattern, or VCP.
Okay.
He looks for shrinking price springs as a sign that a stock is coiling up, like a spring, building energy for a potential breakout.
So it's not just about, drawing random lines on a chart.
No.
He's looking for specific patterns that have a statistical basis and that have proven to be reliable indicators of future price movements.
Exactly. He's combining fundamental analysis with technical analysis. It's a more holistic approach to identifying and capitalizing on high probability opportunities.
And he doesn't just talk about, general market trends, right? He also dives into this concept of a primary base breakout, often occurring in newly public companies. He uses examples like Rambus, which, skyrocketed after breaking out from its primary base.
Yeah, this highlights his focus on spotting those future giants before they become household names. He's looking for companies on the cusp of disrupting their industries that are poised to experience, exponential growth.
So it's about identifying the future Apples or Amazons before everyone else catches on.
Precisely. Companies that are still under the radar, but have that potential to become the next generation of market leaders.
I'm feeling already more confident in my ability to spot these hidden gems. But it's not just about finding great companies, is it? He also talks about the importance of timing. Knowing when to enter, when to exit trades.
Right.
And of course, he emphasizes risk management as a crucial element of success.
Absolutely. He argues even the best companies can become terrible investments if got at the wrong time, or if you don't manage your risk appropriately.
It's like having, a map that shows you where the treasure is, but you also need the skills to navigate the terrain, avoid the traps, and actually come back with the gold.
Exactly. That's where his discussion of risk management and emotional control comes into play. He provides specific tactics, strategies for protecting your capital, minimizing losses, and maximizing your chances of coming out ahead in the long run.
Okay, I'm eager to dig a little bit deeper into his risk management strategies, because they seem even more relevant today, given this kind of volatile market environment we're in.
Well, he offers a wealth of practical advice, from setting stop losses to avoid letting small losses turn into major setbacks. He talks about scaling into positions gradually, rather than going all in at once, and recognizing when the market environment is favorable for taking on more risk or less.
It sounds like it's not just a brilliant stock picker, but he's also a master of risk management and emotional control.
Absolutely. Two qualities that are often overlooked, but are absolutely essential for long-term success.
He makes a compelling case that mastering your emotions, particularly fear and greed, is just as important as mastering your analytical skills. He stresses that investors who can control their impulses and stick to their plan, even during periods of market turbulence, again, are the ones who ultimately prevail. I'm definitely ready to hear more about his insights on the psychology of trading and how to develop that mental fortitude.
Well, he offers a fascinating blend of personal anecdotes, psychological insights, and practical strategies for overcoming those self-sabotaging behaviors that often lead to poor decision-making.
Okay, but before we delve into that, let's take a quick pause here. When we come back, we'll explore Minervini's in-depth approach to risk management, his strategies for maintaining emotional control, and his compelling story of winning the U.S. Investing Championship. Stay tuned.
All right, we're back and ready to dive into one of the most crucial aspects, I think, of Minervini's approach, and that is risk management.
Yes.
He dedicates a significant chunk of his book to this, doesn't he?
He does.
It's not just about picking winners. It's about protecting yourself from those inevitable losers.
He really hammers home the point that no stock is truly safe. Even the best companies can turn into bad investments if you buy at the wrong time, or if you don't manage your risk effectively. It's like having a fantastic car. It can get you places, but without proper maintenance and safety measures, it can also become a liability. So risk management is about keeping that car running smoothly, ensuring it gets you to your destination safely.
Right.
But how does Minervini connect risk management to this often overlooked, I think, psychological aspect of trading?
He argues that many investors get tripped up by their emotions. They'll cling to losing stocks, hoping for a rebound, driven by fear of admitting they were wrong. Conversely, they might sell winning stocks too early, driven by fear of losing their profits.
So fear and greed, these classic drivers of human behavior,
Right.
can really sabotage even the most, well-intentioned investors. How does Minervini suggest we overcome these emotional pitfalls?
Well, one of his key strategies is using stop losses. It's like having insurance on that car we talked about. You might not need it often, but when you do, you're incredibly grateful for it. Stop losses act as that insurance policy, helping you limit potential damage in a volatile market.
That's a great analogy, but I've heard some people argue against stop losses, right? They say they can get you out of a stock prematurely, just before it rebounds. How does Minervini address that?
He acknowledges that stop losses can sometimes result in small losses, but he emphasizes that their primary function is to prevent those small losses from snowballing into major setbacks that can cripple your portfolio. He argues that it's far better to take a small, controlled loss than to ride a losing stock all the way down, hoping for a miracle that might never come.
So it's about having the discipline to cut your losses and move on.
Yes.
Rather than letting your ego or hope dictate your decisions.
Right.
He also challenges the conventional wisdom about diversification, doesn't he?
Yeah, he does.
Many advisors preach diversification as the holy grail of investing, but Minervini seemed to have a different perspective.
He does. He argues that excessive diversification can actually dilute your returns and hinder your ability to react quickly to market shifts. He believes that concentrating your bets on your highest conviction ideas is the key to achieving super performance.
But wouldn't that make your portfolio more vulnerable to risk? What if one of those concentrated bets goes sour?
Well, Minervini acknowledges that. Concentrated portfolios are inherently riskier. But he argues that this risk is mitigated by his rigorous stock selection process and his disciplined approach to risk management. He compares it to a skilled archer aiming for a bullseye. An archer who fires a single arrow with precision and focus is far more likely to hit the target than an archer who scatters a dozen arrows randomly.
So it's about quality over quantity.
It is.
It's about identifying those few truly exceptional opportunities and then committing enough capital to make a meaningful impact on your overall returns.
Yeah, absolutely.
But how do we find those high conviction ideas in the first place? What does Minervini look for when he's evaluating a potential investment?
Well, he emphasizes that it's not just about crunching numbers. It's about understanding the story behind the numbers. He encourages investors to think like detectives, uncovering the underlying drivers of a company's earnings growth and assessing the quality and sustainability of those earnings.
So it's not just about looking at the earnings per share number in isolation, right?
Right.
It's about understanding where those earnings are coming from, whether they're driven by genuine demand or by accounting gimmicks or one-time events.
Exactly, yeah.
He also pays close attention to how the market reacts to a company's earnings announcements, right?
He does.
He's not just looking at the numbers in a vacuum, but also at how those numbers are perceived by the broader investing community.
Yeah, he argues that the market's reaction can provide valuable clues about the true quality of a company's earnings. So if a stock sells off sharply after a seemingly positive earnings report, it could be a red flag that something is amiss, something that might not be immediately obvious in the financial statements themselves.
It's like listening to the whispers in the crowd, right?
Right.
If everyone starts heading for the exits, it's probably a good idea to follow them, even if you don't fully understand what's going on.
Right.
He also seems particularly interested in this concept he calls Code 33, doesn't he?
Yeah. He describes Code 33 as the ideal scenario for explosive earnings growth. And it occurs when a company simultaneously experiences accelerating sales growth and expanding profit margins. It's like a rocket ship,
Yeah.
firing on all thrusters, creating this powerful upward spiral that can drive earnings growth at an extraordinary rate.
So it's not just about finding a company that's, growing its revenue or improving its margins. It's about finding those rare companies that are doing both simultaneously, creating this synergistic effect that can lead to truly exceptional returns.
Right.
But even with all these strategies, we can't ignore the broader market context, can we? Minervini also emphasizes the importance of understanding market cycles and recognizing when the tide is turning.
He argues that even the best companies can struggle if the broader market is in a downtrend. He actually challenges the efficient market hypothesis, suggesting that skilled investors can exploit market inefficiencies to generate superior returns, even in challenging environments.
So it's not just about finding great companies, it's also about recognizing when the market is receptive to those companies and when it's willing to reward their growth potential.
Right.
He also talks about the importance of identifying market leaders, those companies that are outperforming the broader market and setting the pace for the next bull run.
He compares it to watching a flock of geese migrating south for the winter. The lead goose sets the direction, and the rest of the flock follows. By identifying the lead geese in the stock market, investors can position themselves to benefit from the overall upward momentum.
But how do we identify those lead geese? What characteristics distinguish them from the rest of the flock?
Well, Minervini emphasizes that true market leaders often display relative strength, meaning they outperform the market during both uptrends and downtrends. They're like those salmon, swimming upstream, defying the current, forging their own path.
So it's about finding those companies that are bucking the trend, that are showing resilience, even when the broader market is struggling.
Exactly.
But how do we identify those companies in practice? What tools, what techniques does Minervini use to spot those potential market leaders?
Well, he dives into the world of technical analysis. He argues that charts can provide valuable insights into the supply and demand dynamics of a particular stock. He compares charts to EKGs for the market, helping us visualize the underlying health and momentum of a stock's price action.
So he's not just looking at fundamental factors like earnings and revenue growth, right? He's also looking at the stock's price history, its trading volume, and how it's behaving relative to the broader market.
Yeah, he stresses they're trying to trade against the trend is like swimming against the current. You might make some progress, but it's ultimately a futile effort.
So it's about recognizing when the tide is turning and then positioning yourself to ride that wave. But how do we identify those turning points? What specific patterns or signals does Minervini look for on a chart?
He focuses on stocks that are in a clear stage 2 uptrend, characterized by a series of higher highs and higher lows. And within those uptrends, he looks for consolidation periods, which are essentially pauses or periods of rest. Think of it as a climber, pausing to catch the breath before continuing their ascent up the mountain.
And within those consolidation periods, he looks for a specific pattern he calls the Volatility Contraction pattern, or a VCP, right?
Exactly. The VCP is characterized by shrinking price swings, suggesting that the stock is coiling up for a potential breakout. He compares it to a tightening spring, building up potential energy for a powerful move in one direction or whatever.
So it's like watching a predator stalking its prey.
Right.
The predator might pause for a moment, gather its energy, assess the situation, before pouncing with explosive force.
Exactly. And he provides some really compelling examples of stocks that exhibited VCP setups before making massive moves.
I mean, those examples really bring the concept to life. It's not just an abstract theory, it's a pattern that plays out repeatedly in the real world, and that can be used to identify high probability trading opportunities.
Yeah.
But he also stresses that volume analysis is crucial, right?
It is.
Volume provides clues about the conviction behind a stock's price movements.
Yeah, he looks for surges in volume as a confirmation of institutional buying. It indicates that large investors are accumulating shares and fueling the stock's upward momentum.
So it's not just about the price going up, right? It's about the volume behind that price movement.
Exactly.
A high volume surge suggests strong conviction, while a low volume drift might be more easily reversed.
He also points out that low volume during a stock's decline can be a positive sign.
Oh, okay.
It suggests that there isn't a lot of selling pressure and that the decline might be a temporary pullback rather than a major trend reversal.
He also talks about shaking out the weak hands, right? Those investors who get spooked by a brief dip and sell their shares prematurely. He sees these shakeouts as opportunities for stronger hands, those with conviction in the stock's long-term potential, to accumulate more shares at a discount.
It's like a test of faith, weeding out those with doubts and rewarding those who remain steadfast.
He also talks about identifying a stock's pivot point, that price level where supply and demand are in balance. He looks for stocks to break out above their pivot points with increasing volume as a confirmation that the upward trend is resuming.
So that pivot point acts like a line in the sand, separating the bulls from the bears. A decisive break above that line, accompanied by a surge in buying interest, signals that the bulls are in control and that the stock is likely to continue its upward trajectory.
He also discusses the power of gapping up. Those dramatic price jumps that often occur in response to positive news or earnings surprises.
Those gaps can be incredibly powerful signals of momentum, they suggest. A sudden surge in demand that can propel a stock to new heights. He compares it to a sprinter bursting out of the starting blocks, leaving the competition in the dust.
He also warns against buying stocks that have experienced deep corrections, arguing that those stocks often face significant overhead resistance from trapped buyers who are waiting for an opportunity to exit their positions.
Yeah, it's like trying to climb a mountain that's already been heavily trafficked. You'll encounter a lot of obstacles and setbacks along the way. It's often easier to climb a mountain that's less crowded, one that hasn't been trampled by hordes of hikers.
So he's looking for stocks that have corrected the least, those that are showing relative strength, even during market downturns.
Yeah, he compares it to a rising tide lifting all boats. When the tide is coming in, all the boats rise, but the strongest boats rise the highest.
He also emphasizes the importance of following the market leaders, right? Those stocks that are setting the pace for the overall market direction. He argues that by identifying those leaders early on, investors can position themselves to benefit from the broader market momentum.
He uses the analogy of a horse race. If you bet on the horse that's leading the pack, you have a much higher chance of winning than if you bet on a horse that's trailing behind.
But he also cautions against blindly following the crowd, right?
He does, yes.
He emphasizes the importance of independent thinking, developing your own analytical framework, and being skeptical of conventional wisdom.
Yeah, he encourages investors to be contrarian thinkers, to challenge assumptions, and to look for opportunities where others might be overlooking them.
He also shares his own system for organizing his watch list, ranking stocks based on their technical setups and their proximity to potential breakout points.
This system helps him stay organized, focus his attention on the most promising opportunities, and avoid getting overwhelmed by the vast number of stocks available to trade.
He also stresses the importance of patience and discipline, waiting for the optimal time to enter a trade. He compares it to a surfer, waiting for the perfect wave.
Right. A skilled surfer doesn't just jump on any wave that comes along. They wait for the one that has the right size, shape, and momentum to carry them to the shore.
And Minervini believes that investors should adopt a similar approach, waiting for the perfect setup before committing their capital.
Right. He argues that by being patient and selective, investors can significantly increase their chances of success.
He also talks about the importance of understanding the character of a stock, meaning how it typically behaves in different market environments. He argues that by studying a stock's historical price action, investors can gain valuable insights into its likely future behavior.
It's like getting to know a person's personality. By observing their past actions and reactions, you can anticipate how they might respond to certain situations in the future.
And Minervini believes that stocks, like people, often exhibit predictable patterns of behavior. By understanding those patterns, investors can make more informed trading decisions.
Absolutely.
He also stresses the importance of identifying stocks that are under institutional accumulation, meaning that large investors are actively buying shares. He argues that these stocks often exhibit strong relative price strength, meaning they outperform the market during both uptrends and downtrends.
Yeah, he compares it to a rising tide lifting all boats. When institutional investors are buying a stock, like a powerful current, pushing the stock's price higher, regardless of the overall market conditions. And he highlights specific chart patterns and volume clues that suggest institutional accumulation is taking place, such as surges in volume on up days and contractions in volume on down days.
He also emphasizes the importance of recognizing tennis ball action, where a stock's price might pull back briefly to its breakout point after strong move higher, but then quickly rebounds with even stronger momentum.
Yeah, it's like a tennis ball bouncing off the ground. The initial bounce might be high, but the subsequent bounces often get even higher as the ball gains momentum.
So Minervini is looking for stocks that are bouncing back stronger after each pullback, showing resilience, signaling that the upward trend is likely to continue.
He also emphasizes the importance of understanding how to identify when a primary base breakout fails and how to protect yourself from those false starts.
So it's not just about recognizing those breakouts. It's also about recognizing when those breakouts are failing and knowing when to cut your losses.
Exactly. He uses the example of iRobot, the company that he initially bought based on its promising primary base setup, but then quickly exited when its stocks failed to follow through and began to decline. And this highlights his point that even the best trading strategies won't be right 100% of the time, and that it's crucial to have a plan for managing your inevitable mistakes.
It sounds like Minervini's were back, and wow, Minervini's story is it's incredibly inspiring. And it's not just about the money he made, it's the way he approached the whole challenge, the discipline he showed, and really how he kind of proved that anyone with the right mindset can achieve, extraordinary results in the market.
It really is. And it's a reminder that we're not just playing against the market, right? We're also playing against ourselves, our emotions, our biases, our tendency to react impulsively. Those can be our biggest obstacles to success.
So Trade Like a Stock Market Wizard isn't just a book about, stock picking or chart patterns. It's really a guide to mastering this mental game of trading, right? Understanding the psychology. That drives both our wins and losses.
Precisely. Minervini emphasizes that successful trading is as much about managing risk and controlling your emotions as it is about identifying the right stocks.
Yeah, one thing that really struck me was how he talks about the importance of having a plan and sticking to that plan, even when the market is throwing you curveballs, right? Because it's so easy to get swept up in the, excitement or panic of the moment. But he makes a compelling case for, staying disciplined and focused on the long game.
He reminds us that the market is a constant battle between fear and greed, and that the investors who can control their emotions are the ones that ultimately prevail. It's like a marathon, not a sprint. The key is to pace yourself, stay focused, avoid getting sidetracked by those, short-term fluctuations.
He also challenges this idea that you need, some secret insider information or complex algorithms to succeed in the market. He shows that it's possible to achieve, extraordinary results by focusing on the fundamentals, understanding market cycles, and developing a sound risk management plan.
Yeah. And by doing that, he empowers individual investors, demonstrating that they don't need to be Wall Street insiders or have access to expensive research to outperform the market.
And he just seems to have this knack for taking these complex concepts and making them accessible and actionable. He doesn't just tell you what to do, he explains the why behind the what, which is so crucial, I think, for truly internalizing those lessons and applying them effectively.
And he also encourages readers, to develop their own style, to adapt his principles to their own. Risk tolerance and investment goals. He's not trying to create clones of himself. He's trying to empower individuals to become independent and successful traders.
So it's not about blindly following his system. It's about understanding those underlying principles, the logic behind his approach, and then using those principles to create a trading strategy that works for you.
And he emphasizes the importance of continuous learning, right? Constantly refining your skills, adapting to the ever-changing dynamics of the market.
And he seems to embody that growth mindset himself, always striving to improve, his understanding of the market and to share his insights with others.
His story is a testament to the power of dedication, discipline, and a relentless pursuit of knowledge.
Okay, so we've covered a lot of ground, I think, in this deep dive, right? From Minervini's core strategies to his insights on risk management and the psychology of trading.
And we've seen how those principles translate into real-world success, both in his own trading career and in the success of countless investors who have followed his guidance.
It's clear that Trade Like a Stock Market Wizard is not just a book about trading, It's a book